Hey traders, welcome back to the channel. This channel is about my journey selling stock options and getting to the point where I can go full time. And this is my week in review. It's been a couple weeks, so I'm going to go through the whole month of October. Today is the 19th, and I don't think I've done one since September. So let's get into this. Start a Discord if you want to join. You can see my trades and get my thought process for how and why I make my trades, and like how I do my technical analysis, and just share ideas with other traders doing the same sort of method. And it's always good to share ideas and communicate. So it's free. I'll put a link in the description, and you can join it, and hopefully see you there. My overall philosophy right now is changing to only play with like bigger stocks and ETFs. Like QQQ is a ETF of the NASDAQ 100. Bigger stocks like Amazon, Nvidia, that are stable, have good premium, and have lots of volume. And let's take QQQ for example. I started doing straight up puts right at the money, and hopefully, I was going to get it signed and then just sell the wheel. So I can show you what I've been doing there. QQQ on 10.2. Did a trade for the next day. These are daily trades right at the money. The price was 604, and the short strike was right at 602. I did a buy to close on this. I collected 120, and the price had remained above 602, so I bought it back for 13, ended up with 107. Then I just kept doing that, 10.5. I did a trade for 10.6, right at the money. It was a put, and I did a buy to close on that. Collected 115, bought it back for 10, and put on trade for the next day. Again here, right at the money, it's a put. I was assigned for this. The price, strike price was 605. It went down to 604.47, so it was in the money, and I was assigned. So what do I do when that happens? Well, I just turn around. I have the shares now instead of the money set aside, and I do a call. So the call is right at the money. 605 was the price. I did a short strike at 605, and right away I was assigned again. The shares were called away. I collected 262, and it closed out at 610. People get hung up on the difference between your cost and what it runs up to if you have a call out, but I made $262. Then I'm just going to do another put the next day, and these are dailies. So the next day I did the same thing. I did a put, but this was when Trump had announced some China trade restrictions and some tariffs and stuff, and so the market for everything just really tanked that day, and I wasn't sure while it was happening if this was just going to keep going down, down, down. So to save myself, I just closed out the trade. I had to pay $900 to buy this back after collecting 160, so I was at a 740 loss, which kind of sucks. It wipes out a lot of the prior trades I had collected on, but it had gone down way farther than that. This happened on 10.10, I think, so let's go take a look at that in Legend. You can see here the price went way down. It actually went down as far as 582, kind of ended up at like 589. So I'm glad I sold out of it before it went down too far. If I had the intrinsic value of that would have been 610, it would have been assigned, and it had gone down to 589. That's 21 times 100 shares. That would have been $2,100 drop. So I kind of saved myself some headache there. And then so I started looking at doing vertical put credit spreads, which would save me. You've got a short strike, and then you buy a long strike, and that saves you if the price goes way down. If I'm looking at QQQ trade options and I want to sell a put, go like 30 days out, if I went to 602 or 600, I can make $1,364 for this. The delta is 43. If the price stays above 600 through expiration, I would make all of this money. But if it went below that, then I'd be forced to buy the shares. That's not too bad usually if it's just shortly below, because it can just come back up, and you can do calls and make premium that way. But if it shoots down, if it goes to 500, then you lose all that. And so if I was selling a put here for a vertical put credit spread, I could also buy a put at farther out of the money. So let's go like 5 wide, so 600. Let's go down to 595. You're taking some of the funds that you received, 1364, and buying a put with that, so you receive the difference. So for this trade, instead of making $1,300, I'd make $159. However, I wouldn't have to, if this was assigned to me, I wouldn't have to pay $60,000 for 100 shares. My max loss would be, the difference between the strike price, or the difference between the trade prices, which is $595 to $600, that would be a $500 max loss. But I'm collecting the difference between the premium I receive and the premium that I had to pay, which is $159. So 500 minus 159, my max loss would only be $341. So it's much safer. And if the price drops well below $595, yeah, I'll have my max loss, but I'll be capped. So there's some trade-offs there, and you can do these trades with less money. If you get in trouble and the price is between these, you will be assigned. So that's something to watch out for. But you can just close the trade. Usually, that will cost you more than you made on the trade to close those out, and that's the risk you take with these vertical put credit spreads. But they're an effective way. I think I'm going to use going forward. You can see I've got a lot of these on Amazon now. I've got 2 here, and I've got 1 here, and I've got a couple of Nvidias here. So I'm using vertical put credit spreads in a market like this, when things are not just going up, up, up. They're volatile with certain things that certain politicians can do, and they can blow through your put prices. So they can blow through your put strike prices. So what you want to do is kind of hedge yourself a little bit, and that's what I'm doing. So these ones marked in blue, like this Amazon, these are against my leaps. I've got a leaps call that I purchased a long time ago on Amazon. It's due to expire 3/20/2026, and I paid $13,500 for that. And I'm doing calls against this. This acts like ownership of the shares. So instead of purchasing the shares, I purchased the option to buy the shares at a later date, and I'm just using that as my collateral to do calls on. So I collected 832 here. I rolled this for 666 and rolled that out to this next blue one, which would be 1014. Collected 1,008. I bought this back for 108, so I collected 900 there. So this Amazon one in blue here, rolled this. This 666 was from a prior roll. I collected 832 here, and the prior roll I had used, I spent 666, so I ended up with 166, and rolled that out to here. This cost me 108 for this trade on line 4. It cost me 108 to roll this one out, but I collected 1,008, so that's in process. It's against my leaps, and it's going to expire at the end of this month. So I ended up with 900 there. Nvidia, this one, the price had started to go against me, so I rolled it. I had to buy this back for 460, I think, to roll to this point. And then I rolled this out down to here, and I collected 538 on that. And this was the cost to roll it to this point. So I'm sitting at 504 profit on this. We can go look at this one right now, Nvidia. The price right now is at 183.37. It's going to expire at the end of this week, so 5 more days. Collected 269. The estimated cost to buy this back is 212. So I'm keeping a close eye on this one because this is against my leaps. I don't want it to be assigned. If the price goes from 183 above my strike price to 187.5, then I'll have to roll this up and out. And that's not usually a problem. Oftentimes I'll do even, I'll keep this in the money in case there's a downturn. So if the price jumps up, I'll roll this up in the money, or maybe even out of the money. And I can make more premium doing in the money, and if the price drops and you get some downside protection, so it acts like a put. I'll probably just keep rolling this up because Nvidia is the type of stock that'll just usually keep going up. And I think there's earnings coming up for it. Let's go to Earnings Whisper in November 19th. So those are my leaps for Nvidia and Amazon. On top of that, I'm doing some vertical put credit spreads on Nvidia. This one, I did a buy to close. It went against me. 297 is what I collected, and so I had to buy this back for 343. That's just part of the game. You take your losses and move on. Same thing. This one, I collected 225, bought it back for 135, so I ended up with 90. Another vertical put credit spread. I was assigned on this one, so now here I'm selling a call. I collected 75, bought this back for 5, and then with the 100 shares, I'll need to set up a new trade for that. Other trades, I'm doing trades on like Open. I spent a little money to buy a few hundred shares of this. It's pretty cheap right now, and there's a lot of hype around it. It's kind of a meme stock, so I'm taking a bit of a gamble, but it's kind of fun. It's play money to me. And in the meantime, I'm making premium. I collected 81 here, bought this back for 312. What other Open trades are? This one here, collected 225, bought it back for 204, and then I'm just I do have here's another one, 84 collected on that. That's in process. So I'm just selling calls on my 300 shares. It's supposed to jump up, the stock, when the rates go down, interest rates go down. So it's just hovering now below $10, and it's kind of hyped up. I do also have leaps on this, but I'm not trading against my leaps. I'm just trading against my shares that I own. And if the leaps go up, then I'll just kind of watch those go up too and hold on to those and exercise them later. Another big one I'm getting into is AVGO. I have this trade on AVGO. I collected $12.45 for a put on this. It's in process. It's going to expire first week of November. And I got this other one. I did another trade because the premiums are so good. And AVGO is just the numbers of this company are really, really good. It's Broadcom. Price right now has gone down $349.99, but I don't think it's going to go below $325. And if it does, I'm be really happy to buy it there. So averaging those premiums that I just showed you out, it comes to $940, and the price is right now $695. So that should expire and make more money. I would like to own AVGO, but I like to sell puts to get ownership of stock. But I don't think I'm going to be owning this with the price going that far down to $325. I might have to just buy some with the proceeds and use some of the premium I get to buy shares in it direct. I do have 5 shares of it, so that's a start. So that's kind of it for the point I'm at now. I'm collected up to 55.30 if this trade goes through on Monday. That was 305, but so far I've got a few more weeks in October to go. And if I didn't make any more trades and just collected this, I'd be totally happy. I've made a lot of trades, trying out different things. I'm trying to adjust as the market, the market's going up and down really quickly. So I'm doing vertical put credit spreads, which I make less premium, but it's less risk and it's less capital required. So you have to just kind of look at yourself and look at your situation and make those adjustments as necessary. And my philosophy is that you just want to get a bunch of base hits. You don't need to swing for the fences and get home runs all the time. Just get those base hits and they'll add up and be consistent. You don't need to get very exotic. Just puts and calls are the basics that's all you really need to do is do the wheel, and you can make a good side income on this and hopefully someday go full time. That's it for now. We'll see you on the next one. Thanks a lot.